First of all, good morning, everyone. It's a pleasure to be here today. In my role as a CIO for Asia ex-Japan, I represent our investment views and strategies across the platform with clients in Asia. So here I'm presenting to yourself, and we'll run through some of our market outlook. And as the host said, I'm going to dive into the opportunity that we can see in 2023 for fixed income. I just wanted to, before we go into the presentation, give a quick overview of AXA. So obviously we're a global asset manager. We have over 1,800 funds globally across private, public markets. And most recently, for those that have seen, in November last year, we've entered the exchange-traded markets, which is the ETF business. We've launched 3 new ETFs, and we're launching additional ones in 2023, so watch the space. Just diving in a little bit into the macroeconomics, and I wouldn't start the 2023 without giving an overview of what has happened in 2022. And certainly the markets have been driven by tightening of financial conditions in 2022, with central banks looking to anchor the inflation, which largely has originally been driven by supply chain disruptions and subsequently by some of the inflationary pressures on food and energy on the back of the conflict that we've seen between Russia and Ukraine. As we move in 2023, the attention for investors is moving into calibrating the impact of tighter financial conditions on the economic growth. And the investors are debating around what is the pace of Fed, what Fed needs to do for 2023 to slow down the economy, to anchor down inflation with certainty. And certainly as a subsequence of that is, would the US economy or global economy enter a recession? Hence the title of the presentation, Slow Down Slower. And I think if you would say a few surprises this year in a global growth is that the global growth has been slowing down. Certainly that's the case, but it's been slowing down much slower. And we've seen IMF just a few days ago have increased their global growth expectations from 2.6 to 2.9. So certainly a more positive outlook, and we've seen a few surprises that I'm going to go through in the slides. One of the big surprises has been certainly US. A lot of the economists at the end of 2022 forecasted that the US will potentially enter a recession by the middle of 2023. That's certainly now more debatable. And one of the key surprise has been certainly the GDP, surprising on the upside. We've seen the annual GDP at 2.9, or Q4 GDP at 2.9 versus expectations 2.6. And then that has been supported largely by a stronger consumer. And that has been underpinned by tight labor market. And I'm going to break it down a little bit. When it comes to the US tight labor market, it means that the unemployment is very low. But also importantly, what we've seen in the US is when we've seen an increase in average hour earnings, which certainly has provided a confidence to consumer to tap in and excess savings and erode some of that income or some of those savings that have been put in place over the last couple of years. Another surprise certainly has been the energy prices, and certainly the energy crisis that potentially was envisaged to come in Eurozone. Certainly warmer weather on the continent has helped the gas supply and gas storages, and certainly has relieved some of the pressures around the European Union and certainly the recessionary pressures. And we've seen some of the economies certainly reversing their forecast of recession in 2023 to potentially Eurozone engineering a soft landing and pulling through in 2023 in a positive growth territory. Now, I will focus a little bit on oil prices because I think it's important. When you look at the inflationary pressures, certainly the drivers for inflation have been, as I said, from supply chain disruptions on the back of COVID. We've had food pressure inflation, and certainly we've had from energy prices. When it comes to energy, we've seen a deceleration from the top levels in 2022, about 80% down. Now, the expectations are that at some point through 2023, particularly in the second part of the year, the inflationary pressures potentially will be again in the spotlight due to increased oil prices, and largely that's driven by reopening of China. And we'll have some of our other colleagues talking about the reopening of China and potential the positive impact will have on global growth, but also there's a possibility of that putting inflationary pressures through the higher oil prices. The one caveat, a silver lining, I would say, to that reopening is that the first part of reopening For China, it will be very much consumer-driven, less energy-intensive or less industrial-intensive, which again will delay potentially some of the inflationary pressures to the second part of the year. When it comes to inflation, and certainly that, as I said, has been in a spotlight through 2022, it still remains a risk and it still remains a focus for the Fed and for the central banks, I would say largely globally, with exception with China and somewhat Japan. Now, when we look at deceleration of inflation, that journey from 9 to 5 is very much expected to be quite fast. And we've seen a deceleration in headline inflation already, and that's a positive sign. The part that is becoming certainly sticky is the core inflation, and as I said earlier, is largely driven by tight labor market, and that has been filtering through with sticky inflation services and house and rentals in the US particularly, which again is going to be a more long-term challenge for the Fed to bring that core inflation down to the levels. So the expectations are that inflation in the US and developed markets will go to central bank levels, which is around 2% target in 2024. So we still expect to live in an inflationary environment, and I want to reiterate inflationary environment because that is, again, a catalyst and an indicator what is the investment environment for 2023 and why we're advocating staying in fixed income. Certainly an inflationary environment is slowing down in growth. It's more conducive to fixed income than for equities, which is expected to see a lot more volatility as we go into calibrating that damage to the economy or damage to the earnings for companies. When it comes to Fed, and I think there is certainly a lot of volatility in the market around the Fed decisions. I mean, market largely is pricing in a 25 basis points cut increase in March. And after the job report on Friday, the market is pricing about 50% probability of another increase in May. So certainly the Fed has a job to be done, and it's continued doing so until there's clarity around anchoring the inflation indefinitely. So the risk of potential inflation being disanchored, it's a big risk that Fed does not want to go through. So certainly a lot more needs to be done, or some more needs to be done from the Fed, and they will stay the course to get that inflation to the desired target of 2%. When it comes to tight labor market, I talked about it, and this is a chart. Certainly, the unemployment in the U.S. is one of the historical lows, which is at 3.5%. We have an average about 1.7 openings for every unemployed person. But more importantly, as I said, the average hourly earnings is around 4.4%, which is well above where the Fed would like that to be. It's more around 2.5 and 3%. You can see here on the chart at the bottom. Certainly, the desired level for the Fed is around 2%, 2.5% or 3%. So certainly, some more room to be done to bring that or cool off that labor market, and certainly a lot of attention by the Fed will be put on that particular inflationary generator rather than some of the headline numbers related to food and energy. In terms of inflation, and very much debated subject, will the US or will the US not enter in a recession? Will the global economy, developed markets be in a recessionary environment in 2023? And certainly there is no consensus across the street if the economies, developed economies, will be in recession. What we're saying is that certainly some of the indicators that we look at AXA Investment Managers, and this is the top chart, it shows that the recessionary environment, we are not in recession yet in the US, but the probabilities are higher. So certainly we're getting closer to a potential recessionary environment. Now, the chart at the bottom is certainly giving a different message, which shows again, the labor market or the unemployment. So an increase in unemployment of a magnitude of 0.5 indicates that developed markets are in recession, and certainly that hasn't happened. If anything, obviously the unemployment levels are going down, which is, again, not indicated that the US is in recession as of yet, and certainly the economy is running in a good momentum, a healthy momentum, which is a positive overall for the investment landscape, but certainly warrants some more actions from the Fed in cooling off the economies and bringing the inflation down. In terms of the sentiment, and there's a few charts here looking at the macro sentiment, it certainly has improved, but investors largely are still somewhat bearish. and looking for a clear understanding what are the growth parameters, what are the implications on growth to get back into risk. Hence, we're advocating for the period of uncertainty while we're calibrating that implication on growth, staying in defensive, staying and harnessing that income that fixed income is offering until we have clarity around the elements of growth, clarity around the Fed, which will provide a better catalyst for growth investment and certainly for parts of the equity market. With regards to cash levels, and certainly during the 2022, we've seen cash levels increase at historical high, but we've seen that deceleration of those cash levels. You can see the arrow at the bottom chart here. Certainly a deceleration in cash levels, but it's still staying somewhat elevated, with investors being cautionary coming in the market. And if you look at the flows, and we'll see a chart later in the presentation, a lot of the flows for the clients have been coming into fixed income, and certainly in a shorter part to intermediate part of investment grades, which gives, again, a more defensive, a more certain kind of outcome for 2023. Now, the narrative as to where the investors should be looking for investing, and as I said, if there's any positives of out of the 2023 tightening of the monetary policy, is certainly the fact that the 2023 starts of confidence that income will play an increasing role in clients' portfolios. And we've seen the rates across the globe, particularly in the US, rising from almost historical lows to elevated levels, where now in parts of the quality markets, liquid markets, investors can generate good income and harness the income with some degree of less volatility by staying, as I say, defensive in a shorter part of the investment grade universe and harnessing that income until we get understanding of that implications for growth. With regards to credit spreads, and I think it's the questions that a few clients have been asked, certainly the credit spreads across the board in Eurozone and US and in Asia have tightened since the wides of 2022. And the question is, what is the direction of travel for spreads going forward? And certainly this will be very much driven by some of the elements related to fundamentals in a corporate space and the elevated financing levels. And I'm going to break it down a little bit more in details in the next slides. When it comes to investing into investment grade, we're certainly advocating clients to stay invested in a short part of the curve. If you look at the investment grade term structure, or the yield term structure, is very flat due to the inverted government curve. So certainly staying invested in a shorter part of the investment grade universe harnesses and gets you or generates you 90% or close to 90% of the income that you can generate from the entire exposure or entire curve exposure. And you look here, the chart at the bottom, certainly over time, short duration investment grade corporates have tend to provide a better risk-adjusted return. So particularly, again, the sign to reassure the clients of the fact that certainly in periods of volatility like we're going now, staying invested in a more defensive, shorter duration part of the curve provides a better risk-adjusted return. When we say risk-adjusted return, it's certainly returns adjusted for volatility or for the sensitivity in kind of the returns that you're generating. With regards to risks and some of the elements that we need to pay attention when we're looking at corporates, and again, answering that questions, will the spreads widen from here on? And again, we don't have the crystal ball, but we can look at some of the facts and some of the fundamentals in the corporate space. So there is we call it a tug-of-war between resilient fundamentals and higher refinancing rates. When we look at fundamentals, we're coming in 2023 with much stronger fundamentals. When it comes to the refinancing rates, those are much elevated due to the higher rates, government rates. But the important silver lining here is that the maturing or the refinancing wall is getting pushed to 2024. And you can see here at the bottom chart, it shows the investment grade corporates across IG and US, is that the refinancing needs for a lot of the investment grade corporates, and that's the case for high yield as well. We have a separate one chart, reach out if you need the information. But for IG corporates, a lot of refinancing needs are not in 2023. What does it mean is that a lot of companies have raised money in 2022 at much more advantageous financing levels, and they don't have to go back into the market to raise money at a high interest rates, hence preserving their balance sheet, preserving their fundamental health, and are letting them to run in a healthier state through 2023, which is deemed to be a much more sensitive growth environment and certainly a much more volatile growth environment. So certainly a positive sign to say that yes, there is some volatility expected in the spreads, but you would have somewhat contained due to some elements related to fundamentals, but also the refinancing needs for companies are very much pushed into 2024, again, giving a breathing space to corporates to weather through this slowdown period that we're going to see this year. When it comes to fundamentals, and again, just giving you supportive charts to the fundamental landscape when it comes to US corporates, we'll look at two elements here is the net debt to EBITDA ratios, and more importantly, we're looking at interest coverage. So both of those indicators are far from recessionary levels and certainly in a very healthy state. And one important element certainly I would like to highlight here is that companies that have strong balance sheets are better positioned to weather the slowdown. Companies that have fixed debt certainly do not have to be bearing additional financing costs. Certainly companies that have floating rate debt on their books are certainly more sensitive. And then when we look at security selection with our funds, we're certainly looking to eliminate some of those culprits or companies that are certainly have a weaker balance sheets and potentially more susceptible to increase of financial of the financing or interest rates. When it comes to, again, corporate fundamentals, and I'm going to talk a little bit about the reporting season, we've seen the close to 40 or 50% of the S&P 500 companies in the US reported so far, out of which 68 beat expectations. And you would say, and if you look at the actual earnings, they were negative, but the market has rallied, and the reason that it has rallied is because the earnings have beat expectations, and there's very much a question, has the market priced in too much of a negative news over the last couple of months? And certainly the indicator was certainly the 2022 has provided a lot of negative sentiment that is reversing, and certainly a lot of the economists priced in a lot of more negative earnings forecast than it was actually printed out. So certainly the margins again are weakening, but they're weakening by less, so slowing down slower, if you might come back to the title of the presentation. So again, giving additional ammunition for the markets to be running through 2023 in somewhat healthier state. And the point that we want to highlight certainly is, as I talked a bit earlier with regards to central bank policies, as much as we've seen a lot of tightening happening in 2022, so majority of that tightening, 85%, if not say larger than that, of tightening has happened already. The central banks are still very much on a journey of rising rates, but there's less damage to be done from that cycle. So a pause in a central bank or a particular Fed cycle certainly is a positive. And here onwards, the margin erosion, it might not be as high. Again, we have a decrease in overall inflationary pressures. We have a potential pause of Fed somewhere in the middle of this year. And certainly the margins are not as weak as a lot of the economists have forecasted. Certainly, again, giving that period or somewhat being in an environment which is more positive than originally envisaged. So having the ability, so coming back to the spreads widening, we do think they're going to be somewhat range bound. We're going to see some volatility, but certainly not a significant correction in the spreads, allowing clients to generate that income in their portfolios from the investment grade corporates or corporate space overall, if again, going into sub-investment grade, if you can take additional corporate risk. With regards to, again, the picture with downgrades and upgrades, and when it comes to spreads widening, as I said, we have to look at healthiness of balance sheets, we have to look at the ability of company to service their debt, we have to look at financing levels, and those are cumulatively will indicate if we have any revisions in the ratings for the companies, which certainly, again, will provide pressure on some of the credit spreads. When we look at the top chart shows the investment grade corporates, and the bottom chart shows the default expectations for high yield universe. And as I said, as much as we expect some element of revision, even investment grade space and in high yield, we expect those to be below the historical averages. So again, some companies are expected to be downgraded, some companies are expected to default, but again, staying invested through security selection, staying invested in companies that have stronger balance sheets certainly helps investors and clients to weather through and certainly select some of those companies that are potentially culprits and some of the weaker companies in the investment grade and high yield universe. In terms of flows, and I can say as much as I can say around the appetite for investors for investment grade market, but if you look at the flows, that is a testament to where the investors are deploying their cash. And if you look from the beginning of this year, investment grade funds recorded 14 weeks of inflows in a row, and inflows are concentrated in a short duration part of the high grade funds. So certainly close to 9 billion of inflows have gone into that space, and a lot of the majority has gone into short to intermediate duration, and certainly the longer duration, which is the yellow line at the bottom, have seen outflows. So again, clients are still staying very much defensive around rate space. We still expect to see the volatility around rate space. We still see hawkish coming from central banks. So staying defensive, staying in parts of the market that offer more certainty with less residual risk from rates is certainly where the investors have been deploying in 2023. So again, harnessing that income with some degree of certainty it's a good narrative as we enter 2023. Now and then the last and the not least, and this is looking at a few charts. Certainly both stocks and bonds tend to do well after the last Fed hike. And again, we haven't had the last Fed hike yet. It's been pushed from March to potentially May now. The probabilities could see Fed even hiking even further if we see any additional inflationary pressures. And I said some of the pressures could come from China reopening. So certainly the uncertainty around Fed is very much there. So as much as we think that the Fed will pause sometime this year, I think there's still uncertainty around when that's going to happen. And certainly when there's a clear indication of when the Fed will pause or central banks will pause, it's a positive catalyst for risk assets. But while we're waiting for that certainty, certainly investors should be wary of some of the volatility. So the markets are being more like trading versus trending. So if you're looking for a trending market, certainly that's not going to be the period for Q1 and Q2. We'll see a lot more volatility, a lot of trading. So certainly staying invested in asset classes that are more defensive, it's a good place to be until we get clear indication of the Fed path and the pause for 2023. And certainly the chart at the bottom kind of says it all. When it comes to bond yields, they certainly have risen materially, closing the gap between the earnings that we can generate from equities and the yields that we can generate, or the income we can generate from bonds. So again, we advocate for clients to just take the opportunity of the yields that we haven't seen for, let's say, a good 5 years, if not a decade. So take the opportunity of harnessing that income, stay invested, stay defensive, get that coupon, clip that income until we get clarity around the Fed, the monetary policy, to get back into risk and be a little bit more constructive on risk assets across the board. So with that, I think I concluded my presentation. So please do reach out to the team, reach out to myself if you have any questions on the slides, on our investment platform, and certainly on our products. Thank you very much.